There's one undeniable truth for all businesses, whether they are private, not-for-profit, artistic or vocational. Good cash flow management is vital to your success, not only just to your survival. In fact, research that's been carried out by many people found that mismanagement of cash flow contributed to an eye-watering 82% of small business failures. That's a worrying statistic to be sure. Now, as a small business owner, cash flow may feel like that real big burden, anxiety, the bane of your life. But I've got some strategies to share with you today to make the process easier and to ensure that your business, your company, stays on track for financial success. Let's dive into it. Number one, create a cash buffer, a cash reserve. For me, it's always a great idea to have a safety net in place. Circumstances change, business outlooks change, costs increase, activity slows down, so make sure you've got a buffer to cover those unforeseen costs and keep your business afloat should disaster strike. Now, it's a practice that's very common in the artistic, not-for-profit charity sector here, where they build up reserves as part of their governance, as part of their procedures. My view would be, you're aiming for 3 to 6 months worth of operational cash flow as a safety buffer. Think, if activity stopped tomorrow, could you see the storm out for the next 3 to 6 months? Now, secondly, it's about that balance between spending to generate income and being overcautious. Frugality, being cost-conscious, is always a good discipline. Now, it's important to develop a minimum viable budget. Make sure you stick to it, even when things are really flowing positively and money's coming into your business. Good times don't always last forever. We go through cycles. And if you can't save money when the going is good, just think what it's going to be like when things become a little bit tougher. So be cost conscious. It's not just cutting costs for the sake of it, but make sure you get that value for money all the time. Number 3, and this applies to product-based businesses, retailers and the like. Keep a careful eye on your inventory. Inventory represents a cost to you, money tied up, which is worth nothing until you sell it. Manage the inventory correctly, manage it properly, make sure you're not carrying too many lines, make sure that you don't have that big risk of stocking out, being out of product, and therefore you lose demand, you lose sales as a result. It's that balance between not disappointing customers, but making sure you don't have unnecessary funds tied up in inventory. It costs money to hold inventory, not only the people who look after it, not only the storage costs, but also there's a finance cost connected to it as well. And when you've properly organised your inventory, that's going to make sure you minimise the cash burden on your business as well. Look at the items, do a regular stock check, make sure you're carrying the lines that you need to, make sure there's no slow-moving stock in there. If so, it might be an idea to free up some cash and to sell those products off accordingly. The next thing to share is about leasing. So when we have equipment in our business, whether it's computer, technology, whether it's machinery that helps us do what we do, the options are you either buy it outright or you can lease it perhaps. Now, buying the equipment as an outright purchase may benefit you, may give you that sense of ownership, and it may be profitable in the long term. But in cash flow terms, looking at alternative ways, perhaps leasing or hiring the equipment, perhaps not overbuying, could be a real positive move. Especially when funds are tight, leasing, even though financially it may be a little bit more expensive than an outright purchase, will help your cash flow, which is what you want. Preserving cash flow, especially when the outlook looks very negative and very troubling, is really important. Remember, in most hire purchase leasing agreements, you have the option to buy it at the end of the lease term. Now, within that same theme, the next tip is about equipment loans. So rather than buying, rather than leasing it might make more sense for your business to consider what's called a specialist or equipment loan. And this type of loan functions pretty much the same way as a traditional bank loan, but the risk is much lower. Now, before taking out an equipment loan and the market, you can shop around. Be sure to consider how quickly your equipment is likely to become outdated. So if you work in a sector like a technology sector field where things move very rapidly, you might be buying items that become largely redundant in a very short space of time. Now, this might sound counterintuitive. My next tip is about borrowing when things are actually good. Now, prevention is always better than cure, so it sometimes makes sense to borrow money when your finances are looking good. Not only do you command and get better rates from your lender, but it also establishes a line of credit with somebody that you may be able to tap into when things become more challenging for you. There's less likely to be rejected from the banks or some alternative lenders. Borrowing when you need it and when things become desperate and the outlook is very perilous means you'll pay more, but more likely not to actually get the rates that you want or even get the funds. Now, it goes without saying, number 7, make sure you have on your team a great accountant. Make sure you've got an accountant who understands about forecasting, cough, cough. Now, cash flow problems often sneak up on businesses, and therefore it's important that you make sure you've got somebody professional and competent on side who can help put together your cash flow story, who can understand where challenges can be made, costs can be saved, what the future might look like, and building up those forecasts for you. Not all accountants are good at this, but not all accountants are bad on it either. Now, one last tip to share with you is make sure you've got a good system to actually develop that cash flow forecasting. So at my sister company, Numbers Know How, we've got a fantastic product called Budget Whiz, where you can actually build forecasts at a granular level and an aggregate level here. You can look ahead for the future, and you can also talk to your digital system if that system is zero. Now, creating that cash buffer, making sure that you stay cost conscious, keeping on top of your inventory, and you can protect yourself against problems that may arise from cash flow problems. That means you've got a greater chance of surviving the downturns as well as prospering when things become better as well. So maintain that healthy cash flow will make sure that you're going to be here not just today, but next week, the week after, and in weeks and years to come. A healthy bank balance means less pressure on there and more likelihood of your business delivering its why for years to come.